Okay guys, today we're going to look at within planning and implementing debt and equity financing. So it's something we've spoken a fair bit about when we're looking at sources of finance, thinking about retained profits as a source of equity and internal to the business, and then looking at all those different types of debt finance, unsecured notes, debentures, commercial bills, overdraft, leasing, etc. So we're just going to now look at from the planning perspective and in the context of the processes of financial management. Okay, what are some of the key advantages and what are some of the key disadvantages of both debt and equity financing? Again, it's something we have touched on before, just to reiterate some of these key points. Okay, so I'll just go step by step from starting with debt financing. So firstly, there's an element of flexibility to debt financing. We looked at short-term versus long-term, and that's one flexible element of debt financing. You could take out an overdraft, which would be very short term, or you may well take out a mortgage at the other end of the spectrum, which is 30-year purchase of property. And so in the context of flexibility, there's that element to it in terms of time. Okay, it's also flexible in the context of what it could be used for. So it could be used to cover you for short-term issues that the business might have. So the business doesn't have enough cash to purchase stock in the short term. And conversely, it could be used to make a long-term purchase of an asset. So there's an element of flexibility to it there. There's flexibility also in terms of its cost. You may well be able to negotiate a low cost of debt, so that the cost of debt is interest. Having said that, on the other side of the coin, you might go to a finance company and find that you have to pay a much higher rate of interest. So there's to some degree there's flexibility in that area as well. Generally, debt is quite freely available. So the second point here, it's generally freely available. You can go to a bank, you could issue bonds, you can go to a finance company, you could go to a credit union, for example. There are many, or you could issue unsecured notes, debentures, commercial bills. So there's an element of it is freely available, partly because of the number of different ways that it can be, the debt can be achieved or debt can be sought. And there are many different options. It's not just about going to your bank, not just going to National Australia Bank and trying to get a loan. There are many other options which mean it is quite freely available. Another advantage is that the regular repayments of it make the business accountable. So the business generally is making payments on a regular basis, often monthly, particularly if it's a long-term loan such as a mortgage. If it's an overdraft, you generally have that overdraft for a fixed period of time, so the business is accountable to the date at which they must repay that overdraft, or at least the length of time they'll have the overdraft available to them. And if it's things like a commercial bill, for example, they will have a defined time frame on them. So it is making the business accountable for that debt finance. In terms of a further advantage, this fourth point here, the security for the loan equals the sale of assets to recover. What that means is that if the business does get into financial difficulty, one of the benefits is a lot of debt finance will only be provided if security is put up. So when we're talking about a mortgage, for example, and you could look at that as an advantage, because if things do go bad for the business and they need to extract themselves from that debt finance, they have an asset that they can sell which will clear them of their debts, so they won't be left having to make significant repayments over a long period of time. Now obviously it's a disadvantage to lose that asset, but at least that loan can be repaid with the sale of that asset. A couple of other advantages too, you do retain control of the business. So unlike equity where you give up ownership, a clear benefit of debt financing is you're retaining control, and also the interest cost on a loan or a debt finance is a tax deductible expense. And for big businesses, that's clearly quite a significant advantage. A few disadvantages of debt finance. It can be expensive. I mentioned before, you might have to go to a finance company to borrow that capital, and you might be paying 12, 13, 14% interest per annum on that loan. And if we're talking about a significant loan, that's a significant amount of interest. $1 million loan at 10%, for example, you're paying $100,000 of interest for 1 year. Okay, so disadvantages certainly can be the cost. Now, often that could be an advantage too. At the moment, mortgage rates are at all-time lows. You're looking at 4 to 5% per annum to borrow money for a mortgage. So at the moment, that could be considered an advantage. But generally, a disadvantage certainly is that it can be expensive in terms of the interest rate. A further disadvantage is it will add to existing debt levels. So if an organisation already has taken out some debt, that's just piling more debt on top of debt. So taking out further debt financing when debt financing already has been taken out is clearly an additional disadvantage. There may be qualification requirements. So this third point here, in fact, nearly always there would be qualification requirements. You can't just go to the bank and say, "Hi, I'd like to borrow $100,000. How do I get the money?" They want to see records of your business's success. They want to see if you're some proof of prior income. They want to see billing addresses to make sure you're legitimate. They want to see tax records, so that there's a lot of information that banks or any other institution will want to lend you that money, and that is you could see that certainly as a disadvantage of debt finance. Well, I said before that an advantage of debt finance was the fact that you were putting up security and that would cover you in the event of loss. It's also, you could say that is also a disadvantage because you do lose that asset. If you do get into that financial situation where you can't repay your loan, the bank can repossess a property and sell that property from underneath you. So that's certainly, at the same time it was seen as an advantage, you could definitely say that that's a disadvantage. And the last one is a disadvantage. It takes discipline, it requires discipline to make those regular repayments or to make sure you have the money available to pay back that commercial bill, for example, when it matures in 90 days. You don't have the flexibility to pay it back whenever you like, so it requires discipline, and for many businesses, they would perceive that to be a disadvantage. Okay, that's it for debt financing. I'll focus on the advantages and disadvantages of equity financing in the next video.